While 2025 was disappointing for many corners of the crypto market, there's one sector that quietly exceeded expectations: prediction markets. These platforms have grown at an explosive pace, attracting billions in volume and capturing public attention in ways few crypto narratives have managed. But that rapid growth comes with real risks: oversaturation, fragmented liquidity, regulatory scrutiny, and ethical controversies. So the big question investors are asking right now is this: are prediction markets the next major crypto use case, or just another short-lived hype cycle? Today we're breaking it all down: where prediction markets came from, how they actually work, how people are making money from them, and whether this sector is really here to stay. Welcome to Web3verse. Before we begin, a quick disclaimer. Nothing in this video is financial advice. This content is purely educational and intended to help you understand prediction markets at a high level. Always do your own research. Now let's start with the basics. A prediction market is a platform where people trade on the outcomes of future events. These events can range from elections and sporting events to economic data releases, product launches, or even geopolitical developments. Most prediction markets use simple yes or no contracts. Each contract trades between $0 and $1. If the event happens, the contract settles at $1. If it doesn't, it settles at $0. The price of a contract reflects the market's perceived probability. So if a yes outcome is trading at 65 cents, the market believes there's roughly a 65% chance it will happen. If you buy at 65 cents and you're right, you earn 35 cents per share. If the odds shift and the price drops, you can also trade in and out before settlement. What makes prediction markets powerful is that they aggregate information. Thousands of participants bring their own knowledge, research, and incentives to the table. And surprisingly often, the collective result is more accurate than polls, analysts, or media narratives. In fact, prediction markets famously outperformed traditional polling during the 2024 US presidential election, signaling the outcome well before major outlets called it. But despite the recent hype, prediction markets are not new. Humans have been wagering on future events for thousands of years, from ancient sporting contests to political outcomes. In the 20th century, informal betting markets even appeared in financial newspapers. The digital era transformed them. By the 1990s and early 2000s, online prediction markets began showing consistently strong forecasting accuracy. That success eventually attracted regulators. In the US, agencies like the Commodity Futures Trading Commission argued that prediction markets resemble gambling, especially when tied to elections or public events. Several early platforms were shut down or restricted as a result. For years, regulation limited how far the sector could grow. That began to change in the 2020s. A landmark court ruling in late 2023 significantly weakened the argument that election-based prediction contracts automatically constitute illegal gambling. This decision didn't just benefit one company, it opened the door for the entire industry. And that's where crypto enters the picture. Traditional prediction markets were centralized, opaque, and constrained by payment systems and geography. Crypto-based prediction markets changed that. By operating on public blockchains, these platforms gain transparency, censorship resistance, and global accessibility. Anyone with an internet connection could participate. Smart contracts handled payouts. And on-chain data allowed anyone to audit activity in real time. The first major attempt was Augur on Ethereum. It launched with ambitious goals but struggled with complexity, user experience, and ethical issues. Then came Gnosis and its prediction market product, Omen, which improved liquidity and usability. But the true breakthrough arrived in 2020 with Polymarket. Polymarket focused on simplicity, fast transactions, and clear markets. It gained traction during major political events and exploded during the 2024 election cycle. At its peak, Polymarket processed hundreds of millions of dollars in volume. Even after regulatory pressure forced it to restrict US users, global growth continued. And Polymarket isn't alone. Dozens of prediction markets have launched across multiple blockchains, covering everything from politics and sports to AI development timelines and macroeconomic events. The sector is now estimated to generate billions in annual revenue, with analysts projecting significant growth by the end of the decade. But rapid growth comes with serious problems. One major concern is insider information. Because prediction markets react instantly, traders with privileged knowledge can profit before information becomes public. Several high-profile cases have raised questions about whether certain users had access to non-public data, especially around corporate announcements and award outcomes. Another issue is market manipulation. Low liquidity on specific contracts means large traders can influence odds, potentially shaping public narratives. This became a flashpoint during recent elections, where massive bets raised concerns about whether prediction markets could influence voter sentiment rather than merely reflect it. Then there are ethical concerns. Some platforms have hosted markets tied to wars, natural disasters, or deaths, raising uncomfortable questions about profiting from tragedy. Even when these markets are user-created, critics argue that stronger safeguards are needed. Finally, there's the regulatory gray zone. Prediction markets sit somewhere between finance, gambling, and information markets. Different jurisdictions treat them differently, creating uncertainty for both platforms and users. So with all of that, are prediction markets actually here to stay? The short answer is yes. Despite controversy, adoption is accelerating. Major crypto wallets and exchanges are beginning to integrate prediction market features directly. Institutions are using them to hedge political and policy risk. And influential figures across tech and crypto continue to support their utility. Prediction markets aren't just speculative toys. They're becoming tools for forecasting, hedging, and decision-making. So how are people actually making money from them? Some users participate early to qualify for potential airdrops. Others trade based on deep research and informational advantages. And some pursue lower-risk strategies by targeting outcomes they believe are mispriced. None of these approaches are risk-free. Prediction markets can be manipulated. Unexpected events happen. And certainty is often an illusion, especially in politics and geopolitics. The key takeaway is this: prediction markets are evolving into a serious crypto sector, but one that demands caution, ethics, and awareness. They reflect how information flows through society. They reward insight, but punish overconfidence. And they force us to confront uncomfortable questions about truth, incentives, and responsibility. Whether they become a core pillar of Web3 or remain controversial tools will depend on how this space matures. And that's exactly why prediction markets are one of the most important narratives to watch heading into 2026. Thanks for watching Web3 Verse.